So statement of shareholders' equity shows a reconciliation of beginning and ending balances in the shareholders' equity account. We discussed this in detail in our previous class. Next, here we go. What have we been given? An unadjusted trial balance at December 31st, year 6, includes the following account balances. And what are we required to do? It is always recommended when you see a bigger question, you should look at the requirement. So accordingly, you will solve the question. It says what amount should be reported as total equity in December 31st, year 6 balance sheet. So we just have to calculate the figure for equity. And how do we do that? Common stock is equity. Yes, it is. Additional paid in capital is equity. Yes, it is. And what about the treasury stock? Let me take my pointer and then we will solve this part of the question. Here it is. All right. So we will take the common stock, which is clearly a part of equity. Additional paid in capital, also called the share premium, is equity. Treasury stock, we know how do we report it. We report it as a reduction in the equity account. It's a negative item. And then it says net unrealized holding loss on available for sale securities. I hope you people remember other comprehensive income has 4 components, which we discussed in detail in our previous class. So net unrealized holding loss, since it is a loss in other comprehensive income, it will be reported as negative. Retained earning appropriated, specifically set aside for uninsured or quick losses. Clearly, a retained earning, whether it is appropriated or unappropriated, it is part of equity. So appropriated one is also equity. Unappropriated, which could be used to pay dividend, is also equity. If you add all these, and I'm sure all of you got the right answer, it is 1.68 million. So this is how you might be tested on the essay section of your exam. You would be required to calculate the component parts of the different financial statements we have discussed so far. Drawing up a financial statement is very unlikely, so you need to prepare accordingly. Did we do this question yesterday? A public company has declared a property dividend of 1 share of its investment in M Corporation. Did we do this? I don't think so. So I told you property dividends can be in the form of tangible property. It could be bonds, it could be shares. So a public company has declared a property dividend of 1 share of its investment in M Corporation for every 10 shares of its common stock outstanding. Every shareholder who holds 10 shares of my company, I will give him 1 share of M Corporation. M Corporation is some other company. So I am distributing the shares of M among my shareholders in proportion. For every 10 shares in my business, I will give 1 share of M to that shareholder. Ji ansar wa alaikum assalam wa rahmatullah. Okay, this is the property dividend. The M shares were originally purchased by the company for 50 per share. That is the original purchase price, 50 per share. Okay, let's mark this one. This is the original price we paid. On the date of dividend declaration, property dividend declaration, the market value was 75. Ji Imran wa alaikum assalam. As a result of this declaration, the company should do what? We know for sure. When we declare property dividend, the original historical cost is irrelevant. We need to see what was the market value or the date of declaration. The market value on the date of declaration was 75 per share. So there is clearly a gain of 25, which must be then transferred to retained earning, and through retained earning, we pay dividends. I hope you would remember every dividend, cash dividend, property dividend, stock dividend, or stock split in the form of dividend is paid out of retained earning. So this $25 gain, it will go to the retained earning and then it will be transferred to the shareholder. So that makes D to be the correct option. Wa alaikum assalam, Ms. Adia. So it's going to be D. Then next, how would a stock split affect the par value of the stock and the company's shareholders' equity? Now, let's say if you have a 100 real note, right? If you break this down into 10 parts, 10, 10, 10. So your wealth stays the same, your wealth would stay the same. So if the company breaks down its stock to a smaller denomination, smaller par value, so the shareholders' wealth, the shareholders' equity would remain the same, no change. But the par value will fall. It will fall from $100 to $10 or 100 real to 10 each. So the par value will decrease and the shareholders' wealth would stay the same. It's just like you take the change for the chiller for 100 real bill. So it's just that you will have smaller denomination, but the total value of the currency you have would stay the same. First, it was a single note. Now you have 10 reals note, so the amount stays the same. So that is the same concept we have applied here. The par value falls, but equity stays the same. The wealth of the shareholders stay the same. Absolutely right. Okay, then a change in the estimate for bad debts. Remember, some changes are incorporated prospectively, like bad debt. If you change the percentage of bad debts, allowance for uncollectible account, we will discuss in our coming classes, it is going to affect only current period and future period. It is not going to affect your prior period financial statements. So it is treated as affecting only the current period and the future, not the prior period. So which of these do you think is the right option then? It is not an extraordinary item. It is not treated retroactively. Prior year financial statements are not affected. It is treated as affecting only the period of the change. Prior year financial statement requires no adjustments whatsoever. Okay, now here we go. A publicly traded company, a company whose shares are listed on a stock exchange, has 100,000 outstanding shares of common stock with a par value of $5. Okay. Par could be anything, $1, $5, $10, $100, $1,000. It is your choice. When you get your company registered, you may select any par you want. The company uses the US GAAP to prepare its financial statements. The company recently declared 5% stock dividend. Clearly, 5% is a small stock dividend. I hope all of you know when the stock dividend is small, we take the market value of the stock and debit the retained earning with the market value. I hope you remember from our previous class. So on the date of stock declaration, the company stock was trading at $25. The par was 5, but the market value was 25. So in case when the stock dividend is small, we debit retained earning not with the par, rather we take the market value, right? So what we're going to do on the date of declaration, what the company would do. Remember, gentlemen, please, just a quick review. When the stock dividend is small, which is less than 20 or 25%, the entry we make is debit retained earning with the full amount of the market price of the shares. We credit the common stock with par and we credit the additional contributed capital with the extra amount. But when the stock dividend is large, that is greater than 20 or 25%, this is less than, this is sometimes called the stock split in the form of dividend. In that case, we simply debit the retained earning and credit the common stock at par. At par. We don't consider the market price, but here we will debit the retained earning at the fair market value at the date of declaration. So that would mean your additional contributed capital is being credited, so it would increase. Additional paid in capital will increase. So make sure you understand the question well, then you jump to the conclusion. Next, preferred stock and common stock, they differ. Yes, they do. Let us see which of these options gives the right difference between these two. It says preferred stock has a higher priority than common stock. This part is correct. With regard to earnings and assets in the event of bankruptcy, we need to look no further. This is the correct statement. Preferred stock has a higher priority than common stock. When the earnings are distributed, preferred stock are given dividends first. When the business is rolled back, business goes bankrupt, then we will pay the liquidation dividend first to the preferred stockholders, then to the common stock. So this statement is correct. Let us discuss the other statements also. Failure to pay dividends on common stock will not force the company to bankruptcy, while the failure to pay dividends on preferred stock will force company to bankruptcy. Wrong. Wrong. Why? Because preferred stock is equity. Payment of dividend is not a legal compulsion. The dividend may accumulate if it's a cumulative preferred stock, but the failure to pay dividend does not result in bankruptcy. That is possible in case if you default on the payment of interest on your bonds. Incorrect. Preferred shareholders generally control the management. Wrong. They don't. Common stockholders do. Preferred stock earnings are deductible for tax purposes, while common stock earnings are not. This is wrong. Dividends are not tax deductible, whether they are preferred stock dividend or they are common stock dividends. Only interest payments to our bondholders, that is tax deductible. Dividends are not charges against your income statement. Dividends are not tax deductible. Why? Because they are not expenses. Interest is an expense, hence it is tax deductible. Dividends are not expenses, so they are not tax deductible, whether preferred stock or common stock. Okay, then here we go. Again, whenever you come across a little bigger question, it is always recommended to just read the requirement so you solve the question accordingly, right? So it says the investment and inventories are reported at their cost, okay, which approximate fair value. Inventories and investments are reported at fair value, fine. In its year one statement of equity, United's total amount of equity, we need to find out the total amount of equity. So what we are going to do, we are going to identify the components of equity and add them up. Let's see. Cash is not an equity, clearly. Investment in equity securities, remember, it says United Incorporated unadjusted current assets section and equity section of its December 31st year one are given as follows. Unadjusted means there are some problem in the current asset section. Cash is not equity, crossed. But look at this, investment in equity securities. You have made investment in your own stock, means you have purchased your own stock. How do I know? Look at this, United common stock. Who is me? United Incorporated. So basically, when you purchase your own stock, you do not report this amount as a current asset or a non-current asset. This is shown as a part of negative item in equity. Treasury stock is reported as a negative item in the statement of absolutely loss, in the statement of changes in equity. So this is something, this 300 only needs to be considered. Trade receivable is not equity. Inventories, total, nothing. Now, it says common stock is 2.224 million. Retained earning is showing a deficit. So the total equity as on the balance sheet is $2 million. Remember, if this is total equity, the treasury stock is shown as a negative item. So the total equity after adjustment of treasury stock is going to be 1.7 million. 1.7 million, because they're absolutely right. So that would make B to be the correct option. Right? Next. Now, this is a good question. Good question. Again, a longer question, and you are required to read the requirements so you know exactly what you would be doing. Assume that at the beginning of the year, company's equity consisted only of 100,000 of retained earning. This is just assumption that your opening equity is just 100,000. In other words, this is the opening balance, right? Opening balance, okay? Additionally, assume that A uses the cost method of accounting for treasury stock. Cost method means whatever you pay to acquire your treasury stock, you deduct the whole amount from the equity section. This is what we discussed in detail yesterday. What is year one ending equity balance? Okay, here we go. Let's get started. You have 100,000 as the opening balance of equity. Issued 100,000 shares of 3 par for $500,000. You sold 100,000 shares for 500,000. So clearly the amount you received, inclusive of the additional contributed capital, is 500,000, right? Amount over and above the par plus the par value. So this is the total amount you have collected. It is added as a part of equity, okay? Repurchased your own shares from the market at 4 per share. You purchased 50 shares, 50,000 shares at price 4 each. That means you paid 200,000 to acquire your own share. So it is deducted from your equity. Again, reissued 50,000 shares of common stock for 6 per share. So you purchase your own stock 50, you issued 50 again. So basically they are cancelled out, but the amount that you have received is 50 times 6, and that is going to be 300. So it is a plus 300. Okay, then declared but did not pay dividend of 1 per common share. Can anyone tell me? I have declared $1 dividend per share. How many shares are there outstanding at the date of declaration on 1st of December year one? How many shares are outstanding on which I have to pay dividend? Quickly. How many shares Excellent, excellent,
100,000.
excellent. Boss got it right. We got 100,000 shares outstanding because these were the shares we issued. We repurchased 50 and then we reissued. So which means this 50 is cancelled out with this 50. So we have 100,000 shares outstanding and on which we have declared $1 dividend. Remember, if the dividends are declared, still it is debited to the retained earning and credited to the dividend payable. So even it is declared, not yet paid, it has to be removed from equity. So you need to remove this $100,000 from your equity as dividend declared. And again, finally, the business recorded net income of 75. Income is added to equity because it's a part of retained earning and any loss is deducted. So if you add all these, Fraser, you will get B. So that makes 675,000 as you correct.
So I have a question here.
Please, sure.
In
ask.
second point, 3.1 year one, we not in this. The first one.
Okay.
Issued 100,000 shares of $3 par value. Common stock for 500,000.
Yes.
And why we are not considering any additional capital and all this?
Yes, Hashir, you are already considering additional capital because look at this. You have sold 100,000 shares, which had a par of 3. So which means you should have got $300,000. What did you get? You got $500,000, which means the extra amount of $200,000 represents the share premium or the additional capital. So collectively, the total amount you received is 500, and that is what we are considering in the statement of change in equity. So this is the par, and this is the additional contributed capital.
I know this will be crazy, but can we do this? Can we do like this? We will add 300,000 and 200,000.
Yes, yeah, absolutely, absolutely, absolutely. Yes. 2 plus 3 will make 5.
It will look little crazy, but
it's fine.
Because 500 is already there. So why we make it separate?
You are absolutely right.
But I just wanted to clear. But
your concept is fine. Yes, Hashir, your concept is perfectly fine. So the idea is fine. The numbers will be reported this way. So guys, we have done this one. Welcome, Hashir. Now let's a few more questions, then we are done. The purchase of treasury stock, when you buy your own stock from the market, it is recorded on the statement of financial position as a part of statement change in equity as what? It is not an asset. It is not a liability. It is not added to the shareholders' equity. Rather, it is shown as a contra account as a negative item in the shareholders' equity. All the equity items are normally credit balance. So it is shown as a debit, right? So it is shown as a decrease. And the last question reinforces this idea. Which of the following statement regarding treasury stock is correct? It is reflected in shareholders' equity as a contra account. Yes, you show it as a contra account as a negative item, and rest of the options are incorrect. You should have a good reason for the rejection. It is unretired but no longer outstanding, yet it has all the rights of outstanding share. Wrong. Treasury stock are not the same as outstanding stock because they are not entitled to dividends. Anybody, any question, please ask.
So contra accounts mean the negative account.
Negative account. Let me give you some extra example for this concept. You have your long-lived assets. Remember, in the US, we use the word long-lived assets for what you call the non-current assets. So let's say the cost of your asset is 100,000, or let's say $1 million. This is the cost of different assets, land, building, machinery, etc. And we have been accumulating depreciation in a separate account called the accumulated depreciation. So remember, gentlemen, accumulated depreciation is the contra account. It is shown as a negative item in the balance sheet against the cost of the assets, and this remaining 200,000 is shown as the net book value of the asset, right? So accumulated depreciation is a contra account. Similarly, we will also discuss allowance for uncollectible account, which you guys might have read as provision for doubtful debts. Provision for doubtful debt is also contra account. Depreciation is a contra account, negative account. And similarly, the treasury stock, it's a contra account, it's a negative account in equity. So that would make A to be the correct option. So guys, we got the idea. We fully understood the concept of statement of change in equities, different components. Now let's move on to the next topic.